I'm going to start off just by talking a little bit about house prices. Obviously, house prices have been grinding slow and steady historically. If you go back to the 1990s, you saw a big drop at the onset as interest rates started going up. Then, as affordability starts to improve, we'll see more transactions, but prices still need to come down. Interest rates have already done their job. Wage growth has done a little bit of its job in creating more affordability. But most of the gains from affordability come from improvements in house prices. We're going to talk about that today and who really seems to be the buyer group that's benefiting the most from the improvements in affordability. If you look at the changes in the house price index, other than quick rebound market coming out of the interest rate hiking cycle, when we saw the pause and a little bit of optimism in that first spring market, that was the only time we saw year over year increases in price. And then since then, we've been at zero or below zero. Right now, we're at about negative 3.4% on a year over year basis. This analysis comes from RBC. If you're a real estate professional, I would encourage you to pay attention to the analysis that the banks are putting out. The big theme for me right now, and I'll talk about it when I talk about which buyers are actually executing in today's market, but the banks are the ones who really determine whether transactions get done. Everybody thinks it's the buyers or the sellers or the appraiser or the home inspector, but it's really the banks. We're in a credit-driven market where people need debt to buy houses. One of the hallmarks of a recession is something called credit contraction, which means banks are reluctant to lend money. They only really lend money to excellent borrowers. And what that gives us is a market where deals are harder to get done, and really select and qualified buyers are the ones who end up transacting. This is becoming visible in the data. To contextualize the drop in house prices, this is actually the biggest drop that we've ever seen in house prices in Canada, at least on record. This chart here comes from the Federal Reserve in the US, who has better house price index data on Canada than we do. But you can see kind of past corrections. You saw 22% drop over an 8-year period in the 1970s, 21% drop over a 9-year period in the 1990s. So that was like your last major housing correction, the one that I try and draw the most comparisons to. And then 2008, we saw a sharp drop of about minus 10%. You also saw one in 2017, not really noted on the national average here as much, but 2017, we saw B20 stress test. We saw the non-resident speculation tax in Ontario. We saw the foreign buyer ban or foreign buyer tax in BC in 2016, and a little bit of a rate hiking cycle during Trump 1.0. There were consequences to house prices that were visible during that period of time, but not massive enough to really be worth measuring on this chart. And in present day, we're down about 23, almost 24% off peak. This matters from my perspective because I mentioned that house prices are really going to be the driving factor of restoring affordability. As prices come down, people buy more houses, right? If prices come down and they're more affordable, more people will buy that product. And this is really what we're starting to see in Canada right now when it comes to house prices. I'm going to talk a lot about first-time buyers, the job market, housing starts, and the disparity that we're seeing. I'm going to talk a little bit about inflation data, the US Fed, what we can expect from the Bank of Canada by the end of the year, and outlooks towards a recession that we might have. At a national level, we're in a balanced market that slightly favors sellers. You'll see on the top chart here, national sales to new listings ratio. If you go to it on a city by city basis, which BMO has broken down below, you can see that some markets, and it tends to be the more affordable markets, really trend in favor of sellers. The less affordable markets tend to trend in favor of buyers. This is because Canada is a credit-driven market. If people can't take on more debt to buy or pay more for houses, then the price of those houses is going to go down. So markets like Vancouver, I drew a line here at 50%. The red line shows your buyer's market, balanced between 40 to 60% sales to new listings ratio, and the green line is your seller's market. You'll notice that markets that are in a seller's market territory, you've got places like Edmonton, Regina, Winnipeg, Montreal, Quebec, and most of the East Coast. In a buyer's market territory, this is below the black line where you're trending in favor of buyers. You've got places like London, Hamilton, Guelph. And then in your buyer's market territory, you've got markets like Barrie. Toronto's getting there. It was there last month. It seems to ease off a little bit. Summer is tough. I'm always reluctant to use July and August data to make determinations about a market because they're not high volume, so they're not typically reliable. Same thing, I probably wouldn't use a December as a data points out. They really decide on a direction or trend in the market. If you look at this more on an active listings to sales ratio, National Bank put out this chart showing how far it's deviated from its average or standard deviations from the mean. So are we above or below the average? Most markets, including the Canadian average, are tighter than average. Most markets are more in favor of sellers, except for your really unaffordable markets, Ontario and BC. And Ontario is significantly looser than average. So that means market with more supply, leaning towards excess supply. BC would be in the same situation. If you want to kind of get an understanding for this sort of like directionally, you can just look at house prices across different markets: Vancouver, Calgary, Edmonton, Toronto, Ottawa, and Montreal. Vancouver is a market that I would call grinding down. You've seen a steep drop in prices, almost 10% year over year. And now we're in the slower 2 to 3% drop environment sustained over a period of time. Calgary is a market that I would call that has rolled over. So it's come over that high growth and is now dropped below zero. Calgary is actually now down about 1.8% on a year over year basis. And I'm going to go through which markets are winning and losing on a price growth basis across the country. Edmonton is a market that is rolling over. So you can see that Edmonton had this really big run up in price, and then it's starting to trend down towards that 0% line. The expectation would be Edmonton's a little tough because it is a really affordable market, but it does have a ton of supply. And we'll talk about that. I'm going to go through a rental supply scenario, which is important to look at. If you look at markets like Ottawa saw the big drop. It did grind down a little bit, but it seems to be stable above that 0% mark. And I would call that in a slow recovery. The asterisk that I have for the slow recovery for Ottawa is that Ottawa is very vulnerable to government layoffs. The federal government is saying they're going to eliminate something like 60,000 jobs. I think 30,000 of those would be in the Ottawa market. I would say that there's a headwind or risk factor ahead for a market like Ottawa. Montreal is a market that is firmly in recovery. The big reason is it's the most affordable metropolitan market in Canada. Calgary has actually surpassed it. That might change now as prices are coming down or rolling over in Calgary. But if people want to live in a city and they want to be able to afford to live in that city for both rents and ownership, they might go to a market like Montreal where there are a lot of jobs. We've heard that home sales are up in Canada, and they are up. But again, I try not to use July and August data points. Not super reliable. I do think home sales will be up heading into the last quarter of the year. The reason for that is people are buying houses because prices are coming down. And so you're up from July of last year in the number of homes sold in Ontario, New Brunswick, Saskatchewan, BC, the Canadian average, and Alberta. Nova Scotia is up a little bit. July of last year was one of the worst sales months of the year, of history. And so to be up 1, 2, 5, even 10% from that is an improvement, but you're comparing to something that was not good to begin with. I wouldn't say this is super optimistic for the real estate space. It's optimistic that it's going in the right direction, but it's not like all of a sudden all of our problems are solved. We're not in an exceptionally good sales environment. There's a lot of transactions that are not happening, and this is a slow market, right? The real estate market will improve gradually as prices come down or affordability starts to improve. That can happen in one of three ways. Rates can come down, which we'll talk about. I expect we'll see another 25, 50 basis points towards the end of the year. Even though the inflation scenario isn't exceptional, I think we're in a recession, and recession tends to get a lot of those metrics that central banks are looking for back to the neutral range where they're comfortable to cut. And also in the US, the Federal Reserve's discussing cutting. In spite of high inflation, they have a dual mandate, so they'll probably cite jobs as the main reason why they want to see interest rates come down to return some growth to the employment market. On top of what's happening on the resale market, we've seen a huge decline in pre-construction home sales. This chart comes from the Globe and Mail. New condo sales are down 86% off peak in Toronto. As a percentage of average, we're down about 86%. Kitchener-Waterloo, similar to Ontario. Most Ontario markets, Hamilton, Ottawa, are all similar. And we're going to talk about why this is happening and some of the consequences of it. Even markets like Edmonton, Vancouver, and Calgary are down pretty substantially by comparison to what their average sales are. The other thing is that completed and unabsorbed apartment units remain well above the average. So we're also seeing a lot of excess supply in the market that needs to be absorbed. We're hearing a lot about excess supply. where the resale market has too much supply, putting downward pressure on house prices. I would say that we just broke through the average active listings in Canada. So this is back to 1989. Again, the last time we saw that major housing correction. This is your average active listings for sale in Canada. You can see like we've just broke through that long-term average. The important thing to note here is even though we're above average, this is not adjusted for population. If you think about our population back to 2008, out of the global financial crisis to the pre-pandemic era, that was a market where we had above average listings. That was a normal market, right? People were transacting, people were able to make money. The real estate profession was doing fine. Population is probably 10% higher than it was during that period. I always think that relative supply is also an important consideration. Active inventory for July is still below average. This chart shows the same as above, except it removes all the cycles. Active inventory is still below average for July. Our supply from a July perspective is actually not exceptionally high. Do I think this could change? Yeah, I do think that we'll see, as we head into a recession, job losses, layoffs, et cetera, we'll probably see more distressed supply or fewer buyers. That would mean that we're probably trending toward an increasing supply environment, but we're still not there yet. Calgary recently joined Vancouver and Toronto as one of the three markets that have seen a year-over-year decline in house prices. Greater Vancouver is down about 2.5%. Toronto's down over 5%, and Calgary is now down about 1.8%. Every other major metro in Canada is up from a house price perspective on a year-over-year basis, with some markets like Quebec performing exceptionally well. And I'll get to growth in certain markets, not just on a 1 year, but on a 5-year basis. Calgary is doing fine. And then you really just get to your unaffordable markets. So BC and Ontario, where house prices are actually down on a 3-year basis. So you've got prices down in Vancouver, Victoria, Ottawa, and the GTA. Everywhere else, prices have risen in the last 3 years. An important piece to note here is that rents are falling as well. And this is another way that housing affordability can come down, especially when you think about its role in CPI or the inflation, right? CPI is the way that we measure inflation in Canada. And you have rent inflation and mortgage costs. Those are two of the biggest components of inflation. If you take the basket, the only big red flags that CPI has right now are rent inflation and mortgage renewal. So we know that both of those are coming down. Mortgage renewal component of CPI will come down as we get to the other side of the renewal wall, and rent inflation will come down. The RBC chart on the right-hand side here, rents are falling in half of Canada's larger cities. If you look at asking rents by select CMA, rents are falling in almost every city except for Montreal, where they're flat, but low there. So that'll also skew CPI down. This is important because once that decline in rents is realized, CPI inflation will actually come down. The Bank of Canada doesn't really look at CPI, especially the one that includes shelter. CPI will likely end up trending down and below the neutral range as a lot of those costs get stripped out. There is risk, obviously. I mentioned this in last month's report. There's risk that you start seeing a lot of tariff push-throughs, where a lot of the tariffs on U.S. goods end up being purchased in the U.S. for distribution and then distributed into Canada. Those tariffs get pushed through to the Canadian consumer. Also, we had counter tariffs. It seems like we've walked those back, which is optimistic for the inflation scenario in Canada. But counter tariffs would also be absorbed by the Canadian consumer. Those would both be inflationary. That's a bit of a risk, but I don't think it's as substantial of a risk as how much shelter inflation will bring CPI down. The Bank of Canada uses core CPI, which excludes gasoline and shelter because those are so volatile. And so it's not really going to change their decision-making, but it will change what consumers actually feel if their mortgage costs aren't going up or if their rents are coming down. Not that people who are renting units will see their rents fall. If people are shopping around and maybe they rented a place for $2,500 2 or 3 years ago, and then they go and they can rent the same unit for $2,000, they could realize that deflation in rents. The reason that rents are falling and will continue to fall is because we're about to see a record increase in supply in rents. I also did a YouTube video on it. If you scan the QR code on the screen, you can watch that. I also interviewed the economist who did the report. If you want to hear his analysis, I encourage you to check that video out. The chart shows rental market construction and rental market share of the total construction market in Canada. Nearly 50% of all construction in Canada is from rental activity, production of rental units. And CMHC's rental market construction is now the highest number ever been. And it's almost the highest on a per capita basis, which I'll show you in a second. We have record rental completions coming onto the market. This is going to have sustained downward pressure on rents and upward pressure on vacancy rates. For investors or tenants looking for some relief, this is something that you want to consider. Investors obviously want to be modeling in that rents aren't going to be growing. A lot of people doing CMHC MLI Select pre-con deals who are doing buy and hold rentals, pre-con condos that are we have record pre-con condo closings right now. You really want to be paying attention to what's happening with rents and not modeling in that they're going to grow 5% year over year because they did last year. We've seen that rents are falling. We know why, and we know that it's probably going to continue because there's more rental supply. CMHC observed the same thing. They have a chart that shows Canada rental apartment completions from 1970, which was the last era before we really shifted our policy environment to home ownership in Canada. It was a core tenet of the Canadian dream. We built a lot of rental, and then we really just shifted basically set 80s, 90s. We went from basically building no rental housing for 2 decades before present day. You really started to see a ramp up. And then as a CMHC MLI Select product was introduced, rental construction has skyrocketed since then. To observe how much of a role CMHC has, 80% of those rentals actually come from CMHC MLI Select. It's actually 88% from CMHC programs of all types. Report this chart, about 80% come from MLI Select itself, 88% come from combination of MLI Market, which is basically you don't get the extended amortization. It's just kind of conventional CMHC financing. You get a cheaper rate, but normal amortization, normal leverage points. Where MLI Select is you can get a higher leverage point, lower down payment, and up to a 55-year AM. And then they also have something called ACLP, which is Apartment Construction Loan Program, more used by bigger developers. A lot of people claim cronyism in that space. It's really reserved for the biggest and best because that's actually direct money that CMHC is lending. It's not insured loans. The question here becomes, which cities are most at risk for this oversupply? And Central One broke it down really good in the report that I just mentioned. And I would, again, encourage you to watch that video they did with Brian Yu. Basically, you can see the ratio of units under construction to the rental market supply universe. They took the number of units under construction and divided it by the number of rental units that exist in that market. And so you can see the scale goes as high as 30. Kelowna is building about 30% of their current rental supply. The easiest way to think about this, if Kelowna doesn't see any population growth, if it doesn't see any from interprovincial migration or new household formation, then Kelowna's vacancy rate would jump up 30%. Barrie is the Ontario market with over 20% of their current rental supply under construction. And then you've got Vancouver, much of the East Coast, and markets like Calgary. The interesting part is you have to go all the way down the list to get to a market like Toronto, where you've got about 5% of your rental market under construction right now. Even further down, you get markets like Sudbury, Peterborough, and St. Catharines, where they're not building a huge amount relative to their existing supply. The biggest reason why Ontario isn't able to deliver as much is it was the hardest place to qualify for these CMHC MLI Select loans. One of the big reasons for that is the way that CMHC underwrites what they call affordable housing is it's basically local incomes relative to the rents. And I think it's 30% of median household income, which is what they would consider affordable, right? CMHC's criteria for affordable or attainable housing is that you're only spending 30% of your income on housing. They want to enforce that the average market participant would only be spending 30%. In Toronto, our incomes are really low relative to our rents. A developer isn't going to build a bunch of affordable units because they can get way higher rents using either the condo format or not using the affordability criteria. Ontario, in order to qualify for CMHC MLI, does seem to work in markets like Ottawa. Ottawa is actually quite a bit higher up. I think it's the highest Ontario city after Barrie. Ottawa has a lot because their local incomes are high relative to rents. Toronto just doesn't have that. Vancouver, they have a similar issue to Toronto, but their cost structure is different because purpose-built rentals have a lower development charge than condo format. It seems like we might be heading in that direction for the city of Toronto, where they have a new development charge update coming up. There's speculation that they'll be waiving or creating some sort of deferral for rental rather than condo. All the governments are trying to incentivize more rental construction, and it seems to be working. CMHC is playing a big role in this as well. I'm not really somebody who's trying to find the silver lining in things, as most of you noticed, but if there's a bull case for Canadian real estate, it's likely that home ownership is becoming extinct. You go to markets like Switzerland or Germany in Europe where the home ownership rate is way lower. As that home ownership rate comes down, home ownership becomes more and more of a scarce thing. Single family detached becomes super scarce. Toronto will be losing single family detached. Vancouver will be losing single family detached because people will be tearing them down and replacing them with multiplexes. the scarcity that drives single family detached values up, not immediately, but in the long term, will probably be the remaining bull case for single family detached housing as we trend more towards a European housing model. Another way of looking at this is rental units under construction in their entirety. Most of these markets are like hockey stick graphs. Some markets already have a lot of supply and don't show up in the previous graph. Markets like Barrie, hockey stick graph, Calgary, same thing. Most markets in Canada are seeing a huge increase in rental supply. The only ones that really stand out to me as low are the ones that it never really made sense to do. Sudbury would be an example where not a lot of people are building rental up there. The other way of looking at this is relative supply. This is where you can see Kelowna and Barrie. The rest of the cities really aren't seeing a massive increase. Vancouver and Victoria, Saskatoon, Moncton, a lot of the East Coast cities, but you go to a city like Toronto and it's nominal by comparison to existing rental supply in a city like Toronto. Yeah, eventually, yes. I think that's the long-term bull case for single family detached is that we're not building any more of it. It's all being replaced with rental. And so homeownership is basically becoming extinct and it'll become more scarce, more coveted, and more of a luxury product or a luxury good, which sort of detaches it from the broader economy. I think that before we get there, you've got 2 or 3 years worth of rental and condo supply that needs to be absorbed. I think that short term, we are in for some headwinds. You get past that, you've got the other headwind, which is a lot of baby boomers are selling single family detached supply as they downsize. Policymakers are trying to put a floor on that by making these multiplex projects more viable. Now you've added an output value that should increase demand for those types of projects. You've got the two biggest cohorts of Canada's population, your baby boomers and your millennials, are going to move properties as they either downsize or decease. They will move that supply over to the millennials, and most millennials can't afford it. Your marginal buyer can't afford the 4-bedroom McMansion that a lot of baby boomers are selling. So there's very little exit liquidity. That's hump number 2 that we need to get over. Then you're back in a long-term growth scenario for Canadian housing. Depending on how much of that unaffordable supply goes from baby boomers to millennials through inheritance rather than transaction, that could expedite it, but we don't know what that's going to look like. You'd have to see everybody's will. Going back to prices, New Brunswick is actually the market that has seen the leading price growth on a 5-year timeline. So you've got New Brunswick, Quebec City, and Nova Scotia as the 3 leading markets of price growth in the last 5 years. Another thing that National Bank observed that I found interesting was the number of cancellations. I've been looking at this for Toronto, and we just saw 3 months of record cancellations in the city of Toronto. And I think that this is potentially a bit of a pent-up supply scenario heading into the fall market where a lot of people terminate listings to relist them. You've probably got some sellers giving up, but also sellers who will be relisting in September, October, maybe even in the spring. The fact that we've got a lot of terminations sitting here is a lot of people who thought about selling, wanted to sell. Again, what portion of them gave up and decided not to transact is really going to determine the outcome of whether or not we end up in an oversupplied or undersupplied market for the next 6 months. That's a good question. I think that St. John's is a small market and it would only take a handful of projects to move the needle from an undersupplied to oversupplied market right now, but it does seem constricted. We've seen a lot of house price growth year over year in Newfoundland. The driving force for that is baby boomers and young people moving to that market in search of affordability for retirement. I think St. John's is a great market. I want a more small city environment, but I want all of my amenities. I'm going to be snowbird in Florida for 4 or 5 months of the year, the months that suck in a market like St. John's. I would be looking at a market like St. John's. I think that's a big driving force. I think that people underestimate I think everybody thinks about baby boomers as this really wealthy cohort. I think people underestimate how many of them are below the average. If you take your average wealth, statistically or median wealth, half of the people are below that. I think it is a good market for all of the people who are below that line. So I think that piece number 1. Piece number 2 is oil market exposure, which oil is ripping right now. It's the same reason why we're seeing a lot of growth in Calgary. Not the only reason, obviously. And then I also think it's one of those affordable markets, especially even in the East Coast, when you think about your Torontonian, right? A Torontonian went to a market like Calgary or Halifax, then those markets got unaffordable. So the Calgarians went to Edmonton, or the people from Halifax went to Moncton. That's where you get your second order effects. And then your unaffordable people, or the people priced out of markets like Edmonton or Moncton, can go to it. You'll often see people just move within Atlantic Canada, right? Because it is all pretty close, with Newfoundland being the exception. It's pretty far away. So what are my thoughts on it generally? Historically, any market that grows like crazy in Canada tends to come down in the same fashion. with the exception of Calgary, which I do think it's starting to roll over. But even Moncton saw a big spike. It came down, jumped up like 15%, came down 10. So your net gain is 5. Halifax, similar thing, up 15, up 20, maybe down 10, 15. St. John's will probably give some of that growth back, but I don't think it's going to be as severe as a market like Ontario where it's purely credit driven. It's still an affordable market, even at current prices, and Calgary is behaving the same way. So as long as that stays true, as long as there's wage growth there, there's job growth there, then it could still have some stability, but I think it'll give back a little bit of the price gains. Hope that answers your question. I'm going to jump first-time buyers. This is just an Ontario data set from Terranet, our land registry system in Ontario. First-time buyers seem to be back with a vengeance in the Canadian market for the first time ever, other than a very brief period at the beginning of COVID. First-time buyers are now dominating the non-condo property ownership transfers for the last 2 years, and now 33% of all purchases in 2025. To me, this is really important because the question was always, who's coming back into the market? Why are buyers re-entering the market? There's so much risk. When you think about multi-property owners, people who are moving or investors, they're not feeling that sense of urgency based on what's happening. Any losses in the market would also be reflected in the house they're going to sell, or in a risk environment for investors with rents declining. But first-time buyers, for them, it's, okay, I know that I have a 25-year amortization. I'm going to be paying this mortgage for 25 years. Only the next 5 years of it really matters in the current rate environment. So I'm locking in a fixed or even a variable. Not that only the next 5 years matters, but only the next 5 years is really vulnerable to the rate environment that I can see sitting in front of me right now. And most people don't really think about rates this way, but that's how the rate environment works. You don't really know what rates are going to look like from the year 5 to 25. So first-time buyers are coming back in the market because prices are coming down, and they're saying, okay, I don't know how much worse it can get, but I told myself that I didn't want to buy when prices were $1 million in Toronto, but now they're 1.1, and it feels like a market that I can enter. They're buying a little bit more new builds, and we saw the CMHC cutoff just went up. So there's a lot of policy changes that are trying to make the market more favorable for first-time buyers. This is important because first-time buyers generally, if you look at all buyers in the market at a national level, first-time buyers are 50% of your market, according to the Bank of Canada. Investors are still the ones taking the condo market in Toronto or in Ontario. The reason for this is likely because investors are closing on a record number of units. We have something like 50,000 closings, 25,000 next year. All of those pre-con units that were committed to before are showing up in that investor data. First-time buyers are increasing their exposure to condos. And one of the interesting parts is that you're actually seeing single income first-time buyers entering the condo market, which makes sense because a lot of those condo units brought to the market recently are just not suitable for couples, your hotel room sized condos. And so you're seeing more individual first-time buyers, high earning T4 super qualified buyers re-entering that individual condo market. But they are buying cheaper condos. If you look at their non-condo purchases, they've trended up to 720 in the last year. This is Ontario data, and down for the condo to 588,000 in the last year. Again, as prices fall, more people can afford that, more people will buy that. First-time buyers are buying more new condos. As a share of total, the top component of this bar here, the lightest green, is first-time buyers buying brand new condos. It's the largest share that it's been of the total ever. If we look at how first-time home buyers are buying condos versus freehold, Toronto is going to be the hottest market for condos. On the freehold side, you see a lot of first-time buyers buying in Toronto. Durham seems to be massive for first-time buyers buying freehold houses. And then markets like York Region and Simcoe as well. And Ottawa's on there as well with similar growth to a market like Durham. We are seeing a lot more first-time buyer activity in Ottawa and the first and second ring suburbs of the GTA. It's trending in a positive direction. Your average first-time buyer would be doing the math of like, how much does it cost me to rent this unit versus how much does it cost me to own this unit? Vancouver rents are a lot higher than Toronto. That spread is tightening in a market like Vancouver. It still hasn't become more compelling for most people. It still hasn't become incredibly compelling for people to own rather than rent in a market like Vancouver or Toronto. But what a lot of people do is they'll deduct, and this is just mental math and maybe even mental gymnastics that a lot of people do. They'll deduct the principal payment, right? Because they say, oh, the principal payment is money that I'm saving. So if I'm renting, it's a cost of $2,000 a month. Whereas if I'm owning, let's say it costs me $3,000 a month, but I'm paying $500 in principal and then I'm paying condo fees. And so they think, okay, it's going to cost me $1,000 extra, but I get $500 back. This is the way that I think a lot of people think about it. And Vancouver, that gap, that $1,000 gap that I just described, is tightening. Toronto, it's tightening as well, but rents are coming down more severely in Toronto. Vancouver rents came down quite a bit, but they've stopped falling at the same clip as Toronto. I think the market is becoming more favorable as that spread tightens. The market will get a lot better as that spread gets to almost nothing, which I could see happening. And that's where you get to recovery, when it becomes economically sensible for the average owner who can save a 5% down payment to buy a property rather than rent it. I hope that answers the question. Go ahead. For those of you who scanned the QR code on my YouTube channel, I just did a video on return to office. I think it's obviously going to have an impact. Let's say 60,000 people coming back to work. Could be even 100,000. The impact is obvious. There's more people consuming downtown. How many of those people are going to want to move, go get maybe a pied-à-terre, like a little condo that they can live in 4 days of the week? How many can afford that? How many are going to rent it versus buy it? How many are going to maybe move from the 705 to cottage in Kawartha or Muskoka? Now they have to come back to office 4 days a week. Are they going to go to a Barrie where they can still have that kind of lifestyle and take the GO train in 4 of those days a week? So I think your first and second ring suburbs that have transit that can make that commute less painful will probably see some, I don't want to say improvement, because I still think there's a more downward force on those markets. Oversupply, layoff risk, people can't afford it, right? There's affordability, but they'll have some embedded stability. And I do think this is probably a policy objective. All of your banks have exposure to all the mortgages in the 416 and 905, all the condo projects in the 416 and 905. And these are the same banks mandating people back to the office. Do I think this is a little bit of a layer to try and create stability? Yes. Do I think it'll outweigh the raw economic forces in Canada right now? Probably not, but it'll likely support recovery when we get there. 416, I think, will feel it the most. You'll see a lot of people who have geographic mobility. Maybe they're renting in the 905 right now, renting in the 705 right now, and they're like, okay, I'll move back downtown as rents are coming down. That should eventually floor your rents. Will it floor prices? I think it's a gradual thing. People choosing to move downtown, maybe they're mandated back to work 4 days a week in October. By the time it's 5 days a week in February, they're thinking, okay, I can't do this anymore. Now I'm going to buy. A lot of people are going to test the waters before they make that decision, see how bad traffic is, see how bad the commute is, see if there are cheaper options nearby so they don't have to change their lifestyle too much. If they have to make that change, then they're not going to do it immediately. They're going to do it over the next 6 to 12 months. I think it's one of many positive factors for house prices in the 416 and 905, but it's against many negative factors in the 416 and 905. I think it's anyone's guess, but we've probably still got another year of turbulence before these things all become net positive, as a lot of that turbulence gets erased. Rates come down, job losses are done, employment's growing, wages are growing, house prices are down to a point where many more people can afford them. In regards to the first-time buyer bid, the thing I found interesting was your one-party condo buyers. I would have assumed your first-time buyer bid, especially for single condos, would be 30 to 35, but it actually seems like the overwhelming majority is 25 to 30. The largest group is 25 to 30, and then it goes to your 30, 35. So if you break this down, 41% of individual buyers of condos are under the age of 30, which is really interesting from my perspective for real estate professionals, a lot of whom younger real estate professionals more likely to attract younger clients. This is why a lot of realtors focus on first-time home buyers. That market is basically the biggest that it's ever been. It seems like young people who felt marginalized out of the market were waiting for a certain moment to start re-entering the market. We've heard a lot about like buyers on the sidelines. It does really seem like they are trickling back into the market. I won't say they're flooding back because a lot of people can't afford it, but they are trickling back into the market. I'm going to jump through a couple of the other ones. Even on the non-condo side, 28.5% are between the age of 25 and 30, which fascinated me. The interesting thing about single first-time homebuyers and couples is that they're overwhelmingly using big six lenders. Historically, they had, but you had tight spreads where they were doing it less when you were seeing growth in kind of your Alt-A or B lender space. But this is the highest number we've ever seen for single people using big six lenders. And last year was the highest number we've ever seen for couples using big six lenders. The reason I would say that this is significant from my perspective is it really illustrates to me that we are in this credit contraction where your Bs and Alt-A space is becoming less competitive. were just less willing to lend. And so you're single kind of T4 buyers who, again, probably a little bit more financially sophisticated, obviously high earners, AAA buyers. Those seem to be the people who can get debt and are looking at the market and saying, this is something that I want to dip my toes into and gradually start moving towards. And so that's why I mentioned this earlier, but that 2025 is very much becoming the year of the qualified buyer. One of the hallmarks of credit contraction is that people, B or C borrowers, just aren't getting money. Whereas you go back to COVID, B and C and D borrowers, really cheap money flying everywhere. And all the bad deals and overpaying, that was very much a theme during that period. That's going away because lenders are deciding the outcome of deals. It's always been this way, but people don't pay as much attention during a bull run. But now that we're in a bear market, it's clear that lenders are the ones calling the shots. This is a very important theme to think about. If you're a real estate professional, you should have a mortgage professional working your CRM with you, right? You should be pre-qualifying all of your leads, not just as, I don't want to waste my time with unqualified buyers, but as a service, because the best thing that you can do to help somebody get closer to buying a house is actually make sure that they have a mortgage. This is one of the hardest things for people to get in today's market. It's the biggest headwind for people to make a transaction. We are seeing a big uptick in mortgage activity. This is the second highest June on record for mortgage originations, which basically means new mortgages. It's not because there's a ton of new transactions, as we've already discussed earlier in this call. Transactions are at a really low level, but there's a big piece coming from a lot of condo completions observed by Better Dwelling. A lot of pre-con condo buyers, there's 40 to 50,000 condos closing this year. So that's going to give it a big jump up. But then the other piece is that we're at the renewal wall, right? The renewal wall is here. Every renewal that comes up can get shopped. It can become a new mortgage, or it goes back to that lender and that becomes a mortgage origination because it's a new 5-year term. We're finally in the middle of that renewal wall. And this is the remaining big headwind. As we get to the other side of that renewal wall, 60% of mortgages are supposed to renew by the end of 2026. That's when you can think about a recovery in Canadian real estate, but not until then. Everybody needs to reset at new rates, get into this new credit cycle. Historically, it's a big jump. So the chart you see here looked like a pretty steep jump, but historically, we're well below your historic pandemic level or even a normal market era of growth in mortgage debt. We're not in a market where we're seeing a ton of growth in mortgage debt, even though if you look at month over month or year over year trends, it looks like there's huge growth. We're not in a really robust lending market. Your loan to income rate is increasing, but debt service ratio is decreasing. Rates are coming down, so people are paying less relative to their income on their mortgages, even though the loan amounts relative to their income are increasing. People are flipping less houses. I think that's it that I want to cover in regards to rates. This is an interesting analysis from RBC. I also covered this RBC report, which I'm going to try and very quickly rip through because I realize that we're tight on time. But basically, the rest of Canada is building a ton of housing. I showed that in those rental charts, but Ontario is really falling behind. When somebody asked me about single family housing becoming scarce, this is one of those big long-term risks for Ontario. Could that make single family housing more and more affordable later? Absolutely. The big reason why we're seeing a decrease in construction in Ontario is because construction costs have outpaced everywhere else. And because there's more resale supply available, there's not a lot of excess demand. The big reason the whole condo thing happened during COVID was there was so much excess demand. So many people wanted to buy. There was limited availability in the resale market, so it spilled over to the pre-con market. Now you have the opposite. There's so much available in the resale market, nobody moving over to the pre-con market. As a result, Toronto condo starts have plummeted pretty substantially. And you can see the yellow line here that tracks it pretty consistently is your pre-construction sales 1 year prior. So you would argue that this condo start line is going to continue trending down. Ontario municipalities are still issuing a lot of building permits. They're just not getting filled. You can see Canadian housing starts, huge increase in rental and apartment buildings, huge decrease in detached. Basically, detached is the lowest it's been and stuck there. So we're not seeing a ton of detached construction. Just an interesting thing that a new survey from Nanos, more than half of Canadians believe that house prices need to fall to make the market better for future home buyers. I'm going to try and very quickly wrap up on interest rates here. Basically, CPI is down, core CPI is not down, no gasoline or shelter. And so the Bank of Canada tries to strip those out to remove some volatility. Core CPI is not where they want it to be, which is really not creating an exceptionally positive scenario for cuts in the near term. I still am of the opinion that we'll probably see 25, 50 basis points towards next year, another 50 plus by the end of next year. The key thing to watch is what's happening in the US, because we have forces now that are giving us this risk of imported inflation in Canada right now. The Canadian dollar gets weaker if we're ahead of the Fed. Number two is they're collecting tariffs and then passing those costs through to Canadian consumers as they export goods to Canada. Those are both imported inflations and not within the scope of what the Bank of Canada can control, except if we want to keep the Canadian dollar in a safe spot relative to the USD. They don't want it to get too high, which is why they might cut to protect export activity, especially because our exports are subject to tariffs in the US. But they don't want to cut too far to weaken the Canadian dollar so that we're importing inflation via foreign exchange. Yeah, so I hope that covers everything. Happy to do any questions if anybody has them.